Welcome everyone to another Roundtable Twitter Spaces by Morningstar Ventures. This week we are going to dive deeper into the DeFi trends and what we can expect in 2024. We have here with us Eden from AARK, Ritwik from SYNTHR, and Brian from Partisia. As you can also hear, I'm not Naini because my colleague Naini usually hosts these spaces with Peter. However, she's a bit ill. Therefore, I'm going to try to fill the big shoes. So I hope that I will succeed on that. But nevertheless, I think we should start our spaces. Also remember that this space is recorded. So feel free to listen back anytime you want here on the Twitter or on any podcast platforms like Spotify. We are everywhere, actually. There will be 15-20 minutes at the end of the spaces for questions, for Q&A. So if you have any questions, then you can request to be a speaker and you can ask your questions at the end of this chat. Also, if you just type it in the comments, that's also great. And we can read it from there. So yeah, I think we are good to go. So I think for an icebreaker, let's start with a short introduction from all our guests. And yeah, who wants to go first?
Yeah, happy to. But hi, everyone. I'm Brian Gallagher. I'm one of the co-founders of Partisia blockchain. We're a layer one protocol. We have, our specialty is in MPC technology. So our token name is actually MPC. We're launching on exchanges pretty soon. We solve interoperability by using our MPC tech to run a very secure, decentralized bridge. And so the way it works is we have 100 node operators. We do a random rotation of 3 nodes. Every time someone uses the bridge, we containerize about 100 ETH before a new epoch is formed. And it's always rotating random node operators that are using threshold key signature schemes to secure the assets inside of this cross-chain oracle. So we think we have one of the most decentralized and secure bridging architectures ever deployed in the industry. That's totally open source and transparent. And we also collateralize the nodes with MPC tokens. So if there's 100 ETH in an epoch, there's 100 ETH worth of MPC underlying the epoch. So if something does go wrong, 2/3 of those random nodes that were selected go rogue and try to steal funds, their collateral gets seized. So it's a well thought through bridge and security model. We also have private smart contracts on the blockchain, so you can do use cases like voting, where you can see who voted and what the outcome is, very transparent, but you don't know who voted for what. So you give the user that level of privacy. And that can scale across thousands of use cases. So layer one infrastructure, wide range of potential use cases, focusing on security, privacy, and interoperability.
That's great. Thank you very much for the intro. We will discuss about the products later a lot. Let's continue with the intros. So Ritwik, maybe you can continue.
Sure. Thanks so much for having me here, guys. So my name is Ritwik Rudra. I'm one of the co-founders of SYNTHR. We're building DeFi's first slippage-free omni-chain liquidity layer. We're building this using highly solvent and omni-chain synthetic assets. What kind of sets SYNTHR apart is the way SYNTHR is designed its omni-chain architecture, which allows users and liquidity providers to effectively take collateral on any chain, mint a synthetic asset on any chain. And this liquidity layer of synthetic assets, which are effectively free-floating across every network, is they're backed by collateral, which is pooled and aggregated across all chains. So it's more than just a regular synthetic asset protocol, because what we've effectively done is we've created this aggregated pool of collateral, which has gone on to back cross-chain synthetic assets, which are free-floating across all ecosystems. And users, applications can all use this liquidity layer, which is built using these synthetic assets, to go from one chain to the other in without any barriers to entry, right? So it's because there are 2 barriers to entry which we're effectively addressing with this. Number one is capital inefficiency, which is why we often see most users resorting to CEXs to perform their cross-chain transactions, and the underlying security, right? Because cross-chain transactions are very, very insecure when it comes to lack of security. And they obviously get addressed to a great extent through these closed-ended systems. But if somebody has to free float across open ecosystems, there are security challenges and capital inefficiency challenges. So both of these things get addressed. So it's probably the safest and most capital efficient cross-chain transaction environment that we're effectively creating, which both users as well as applications can tap into.
Well, thank you very much. Lots of information there, so we will dissect that in just a second, but let's hear Eden. Maybe Eden, you can also give us a brief introduction about yourself, about what you do.
Hello. Hey guys. So we're Perpdex. We're an Arbitrum. Recently we won the Big Bang contest for Blast. So we're excited to move on there. The differentiation is for us is two things. On the trading side, we have 1000x leverage. So right now we have BTC ETH, we have exciting coins like Jupiter Blur. So that's exciting. On the LP side, you can stake LRT assets and you can get yields on top of your PT tokens, your ST tokens, and your LRT tokens. That's it. Thank you.
Okay.
And one more thing I'd like to add, Eden, you guys have a fantastic UI, by the way, right? I'm a big fan.
We have a really nice UI. Thank you so much.
Yes.
I wish
I'm a big fan myself.
Everybody's just so used to order books. We should just get order book. Thank you so much, man.
Yeah. Man, I really love that this conversation is starting with in such a friendly way. So maybe we should discuss our first topic if everyone agrees. So since the first DeFi summer in 2020, the ecosystem has grown and we saw the rise of new layer ones, count abstraction technologies, bridges, synthetic asset management, and many more. Despite all this, what stops users' missions of utilizing DeFi solutions instead of centralized exchanges? I think that is a very big question, and we are looking for the answer for maybe years now, maybe since 2020. So let's go one by one, and I'm very curious about what you think. What could be the incentive to move the users from CeFi to DeFi? Who wants to go first? Should we go the other way around now? So Eden starts.
Yeah. So initially I was thinking the user experience was the hurdle because of the wallet. But I seen like when I was preparing for the recent round that we were doing, I was doing some research and a lot of the people said that UX was actually one of the smaller reasons why they use DeFi. And one of the bigger reasons was security. So if you guys like see like 100 mil, $1 billion get hacked and you're like, oh, that's fine. I see it every day. That means you're super degen, but we're like 0.01% of the population. And most of the people think it's insane. Even like $10 million of hack would be super insane. So I think that's what's really happening, stopping the mass adoption. Like even if centralized exchanges do sometimes have security issues, you at least have someone to complain to. But since most protocols on DeFi are decentralized and a lot of the protocols are also anonymous, I think that's the less stability and security is what's really making the people stopping from coming. So I think there's a lot of interesting solutions that's coming to the industry. The recent thing I saw is what OpenEden was doing. So even if you deposit in the contract, they actually move it right away to a centralized custodian. So even though there was a lot of DeFi hack cases, there has not been a single case where a centralized custodian was hacked in the entire history of crypto in the entire world. So they really make it safe. I really don't see a reason why liquidity has to be on the DeFi space. So that's a solution. Another solution that we're adopting a thing called circuit breaker. Usually circuit breakers happen when price volatility is too high on centralized exchanges. And for us, what happens is if somebody is making way too much profit, like something that would not happen even in like an extreme case, or there's a extremely big withdrawal, we have a halt to it. So it basically acts as a circuit breaker where there's abnormal activity happening and it stops it so that we can look into it. And if it's a irrational case or abnormal case, we can go back to it and fix the problem. Thank you.
Okay. Thank you very much. Thank you very much. Ritwik, I think you are up next.
Done. So I think what my friends over at Eden spoke about is actually true. I mean, we also kind of thought about maybe say a UX issue probably being the primary reason, but that's actually not true because so I think the UX issue is very broad and encompasses quite a lot of things. Number one is definitely the wallet being in the play and the whole security aspect of keeping a wallet secure. If you lose your keys, your funds are gone, etc. The UI did play a key role, but then we were comparing a couple of say these trading portals which are actually sort of allow users to perform sort of futures and options trades on the TradFi side of things. They are also fairly complex. So it's not that the UI is also a big concern. And other than that, from a liquidity standpoint, I think a lot of DeFi protocols are pulling in, a lot of liquidity, right? At times, it's just a better experience just trading on, say, a perptex as opposed to a SEX because of certain opacity around certain measures, be it the risk measures, be it asset listings, etc. Right? But one of the reasons why I kind of feel that what's actually going to cause sort of this big migration from, say, the Web 2 to the Web 3 space, or like getting more users from CFI to DeFi. I mean, we guys are all like sort of DeFi natives, right? We are all crypto natives. Like, the previous speaker just spoke about how we're okay with funds getting hacked and etc. because we're like, yeah, crypto is risky, so deal with it, right? That's how it's supposed to be. I mean, you first have to learn how to protect yourself, and only then can you think about making some real bank. But what the CFI user is very, very used to, so it's not just a smooth interface. It's not just how pretty everything looks. It's not just how much liquidity there is, etc. They are used to somebody being responsible if things go wrong. I mean, they need a door to knock on if things go wrong. Because in my previous experience, me along with a bunch of folks, we built India's largest insurance aggregation platform, right? We IPO'd in 2021 at a $6 billion valuation. And so we built a product which was selling insurance online, right? And we ran a very interesting experiment. We said, okay, you know what? So insurance has always been sold through assistance, right? It's been sold by that person at the bank. It's been sold by an agent who comes to your house and sells it. But what we kind of wanted to experiment was, you know what? We are a fintech product. We are a tech-first product. Why can't people buy insurance themselves? And we ran an experiment. We said, okay, if you buy this product yourself without any human assistance, we'll actually offer you, say, a 10% discount on the price, because I obviously had a higher cost of getting that product sold through an agent on the other side. And this agent was an agent who would probably get in touch with you, provided you would request some sort of assistance, right? So somebody on a call would get on call with you and handhold you through the entire process. Despite that 10% discount, the user still requested somebody to be on the other end so he or she could talk to. So then we ran another experiment. We said, okay, let's increase this discount from a 10% to a 25%. We still did not see the needle tick. And then we kind of understood that this user wants to come on, wants the benefits of being able to compare products online and then make a more informed purchase. But at the time of purchase, he or she wants assurance that, you know what, I spoke to somebody before I bought this product. So if things go south, if shit hits the ceiling, I know whom to call and I have a door to knock on. I think similarly in DeFi, what we need to work on is, and I know I might be just like overshooting myself here, but we need to focus on like user support. We kind of rely on Gitbooks and YouTube videos to solve the problem. But what I kind of feel is, you know what, we need to have user support to be there, because if a user is actually facing a problem, we tell the user to just fend for him or herself. There is no hand holding. There is no person on the other line who can actually help the user out. And most importantly, like imagine the amount of bridge exploits that we've had. There are exploits which happen in CFI as well. And I'm not saying that everyone gets settled, but the user has somebody to call up or some door to knock on and some shoulder to cry on. That is not there in the space that we guys are creating. So on the tech side, because we're all tech natives, right? So we understand we are high on IQ, but we also need to build the EQ side of things, knowing that, you know what, this CFI user is very used to a protective environment. It's like a child that is entering college, right? And and imagine a child like entering a college which is completely decentralized. I mean, it's going to take, I mean, some will exceed, some will excel, but most will find that very difficult to cope up with. So when you go from, say, one level to the other level, the kind of support system changes. So we will need to think about these support structures that we'll need to build so that this user can actually be handheld.
Yeah, so
As a
I agree. I agree.
I'm so sorry. I think I overshot my time, but yeah, I'm so sorry.
So look, I mean, I agree with what you're saying on the part of, customer support, but the truth of the matter is the world's heading towards pure automation and removal of the need to speak to people. And so like the way we are trying to address it is collateralization. So like if there's massive liquidity pools, there needs to be insurance on the chain to support that pool in case it just gets rugged. And so like, in our case, we have all of the cross-chain bridging, secured by the MPC token as collateral. That's not a perfect model for the long run, because if something went drastically wrong that was more of a network or protocol issue, you could argue that the collateralized asset would lose value rapidly and no longer have the same backing. So like there's an argument against it, but it's a good first step towards like a pure automation system. But you could imagine, like, let's say you have $1 billion pool of like ETH and USDC. You could have a bonded insurance pool that people put into that collects a % of the fees for providing the insurance. Like we haven't really seen that done well yet in crypto, but I think that's something that's kind of low hanging fruit someone's going to do it, right? Because like at the end of the day, it doesn't need customer support or calling people. It needs instant automation to replace the problems, and like that's the promise of blockchain. Like we're working on some micro insurance policy stuff where it's like, if you pay $8 to insure your flight and the flight gets canceled and you get your $200 refund, in 10 years, you shouldn't have to call and document that your flight got canceled. There should be flight data running through an Oracle, which feeds the smart contract to let them know to, deduct out of this pool the $200, refund right to the user's wallet who bought the insurance. Like the world is heading towards like this type of automation and optimization. It's going to take like 10 more years, so it's still ways away, but I think that's ultimately where we're heading. So like to think of it in the context of like building up customer support in that, I think that's kind of like, let's just focus on like getting the automation right and like tying in the proper data feeds and oracles. So there's collateralization is a big thing that's going to bring more people to DeFi because it's on-chain guaranteed automated, monetary security if something goes wrong, which is that's enough to convince people, I think. But the other thing is just time and age. And what I mean by age is like the users who are using DeFi, like, my father's great, God bless him, but he's 73 years old. When I try to help him move his Bitcoin around, it takes like an hour and a half of, for something that should take like, 3 minutes.
It's amazing that he holds Bitcoin. That's encouraging in itself, sir.
Yeah, he skipped like 1 or 2 cycles from 10 years ago before he finally, bought in. But he did well for himself. So better late than never. But his generation's never using DeFi, and the 16-year-olds who are getting into crypto, they are. So like it's really about like the new age users coming in, like they're going to be using the tooling. They're going to be learning from day one how to use it, and like we're already just improving user experience, user interface every day. Like it's just coming regardless. So I think it's a time thing and just like age of who the users are. We have the Bitcoin ETF. Those people are never using DeFi. They didn't even buy Bitcoin until they had an ETF. They literally waited all the way until an ETF to tell their broker to go get it for them. Like they could have done a Coinbase account. They could have done other stuff. They waited that long. So like they're never going to use DeFi. So it's like, who are you targeting as a customer? And then lastly, just like the interoperability of non-EVM assets. The second that Bitcoin can move easily, like Ruin, Thorchain does a pretty good job. We're working on a more decentralized version, which takes a lot longer because Bitcoin is just very bare bones. But as soon as you can facilitate, XRP, Bitcoin swaps that are, secure, collateralized, I think you're going to get way more adoption because like that's the top trading, volume assets, but they kind of aren't in DeFi unless you're doing a custody version like WBTC. So I think those are the main components.
Thank you so much, everyone. Really great points highlighted. I just remember our previous roundtable about DeFi in 2023 when we spoke like the half of the time about user experience, keyless wallet experience, and different like improvements on this side. And today we outlined more important, not more important, but other problems and other challenges that we are aim to solve in 2024 for our ecosystem. That's very great to hear. And let's move on from challenges to narratives. Let's discuss a bit the crypto narrative. So how does the new narrative like RWA, AI, SocialFi, or DePIN affect the DeFi industry, given that DeFi is basically a fundamental layer for all financial operations and all asset management on the blockchain? So who wants to take this one first?
I just spoke. Why don't we just go in the same order?
Ritwik, Eden, who wants to go first?
Yeah, I can take this. Of course, I can take this. So from an RWA perspective, I think instead of like from an effect perspective, it's definitely a positive effect, right? Because creating like synthetic assets for a liquidity layer, that's something that we're doing. We also have another aspect that you're exploring, which is effectively trading of synthetic assets. If you have the RWA narrative coming on board and you're looking at tokenization of RWAs, then you're also looking at trading of these RWAs. And then we being a liquidity layer, which is backed by synthetic assets, it actually makes sense for us to explore that as well. And that's something that we're actively exploring. And a couple of things that I think are also gaining a lot of steam. One is and they also end up affecting sort of the DeFi industry is, I think the LRD narrative is really kicking off, right? I mean, it's not that restaking or staking are terms which are new for us. I mean, we've already seen this cycle after cycle in different forms. Debacles of the last cycle were as a result of something like this. But anyway, I kind of feel that the whole liquidity staking narrative kind of helps bring in obviously this liquidity was already there. It was just in crevices, and these kind of narratives help pull out these dormant this dormant liquidity which is sitting, and then just brings it back into action. So that is something that just spurs a lot of liquidity which is coming into DeFi, and I somehow feel that's going to aid liquidity in the future as well, because currently what a lot of pop dexes are also now exploring, and some of them are doing that really well. We're also going to be exploring that from a collateralization perspective, is that why can't you just collateralize your sort of synthetic assets with not just short tail native assets, which are probably say a ETH USDC or a USDD, but why not also an LST token, right? But why not back it, say, using a staked ETH or maybe like Curve LB tokens, etc., etc. We can probably explore that side of things as well. So something that's very, very important to us is, so we are observing the RWA narrative shape up. We're also going to be partaking in that narrative very, very soon. We've already begun sort of work on the off-chain side of things, because there are a lot of off-chain work which goes into setting up the RWA infra. And because the on-chain stuff is already ready for us on that front. And we're also really exploring the LRD narrative as well. And we are stitching that up into SYNTHR as well. So these two things are something that we're closely focusing on. Yeah.
Cool. Really interesting. Definitely keep us posted on your place on the off-chain stuff and connecting on-chain and off-chain liquidity. Eden, do you want to share more? Probably also expand on the topic of restaking and liquid staking, which is a big thing in 2024, and what you're integrating with AARK.
Yeah, sure. So I just want to answer the question first. So AI, SocialFi, DePIN, I personally don't believe in any of these. I think looking back into 2021 when the NFT hype was here, It's definitely an interesting technology. I think in the long term, with metaverse and everything, it could succeed. But the issue with is like everything in it about NFT is just trading it, buying it cheap and selling it really high. I think very few projects succeeded in making it actually a cultural thing. So this expands to everything else, like SocialFi. Like I think the moment that finance comes into something, it really degenerates the essence and what it's supposed to be. So um, I'm not too positive about DeFi making any synergies with any other sector, but of course I do think that DeFi in itself is very valuable. And thinking about LSTs and LRTs. So there's a lot of talks going on these days, right? Some people saying, okay, LRT, this is just a copy and paste of LST. It's a bubble. But I'm an ETH maximalist. I don't believe that any other chain should exist other than Ethereum. I think if you go down to layer twos and layer threes, the functionality is practically the same as um, whatever like parallel blockchain, high frequency blockchain that you can make. So Ethereum as a settlement layer and everything else built on top of it, I think we don't need any more blockchains. And in the long term, I believe that it's all going to converge to Ethereum. So in speaking from that perspective, I think LRT is very valuable. Eigenlayer, Outlayer, they made it possible for us to build app chains. And app chains kind of make sense. And if we don't have now, like, so the question now is, why do we need Cosmos, right? Everyone can just come to Eigenlayer and Outlayer and build the same thing they were doing. And some people might argue Solidity is what's that word? It's not a good tech stack. It's not a good language. But now like other layer threes are enabling other code structures as well. So the question is, why do we need any more blockchain other than Ethereum? It's the only blockchain that has 300,000 validators. All of the other blockchains validators combined times 10 is still less than Ethereum. If you have this settlement layer that's already super decentralized, stable, has a value, has a community, has an ecosystem, um, I don't think we should expand to any other chains and explore the risks. So in that sense, I think LRT is very valuable. It's going to be a huge asset class in DeFi. So the question from DeFi protocol's perspective is, how can we utilize this liquidity? And thankfully, we are peer-to-pool perplex. And if this liquidity is acceptable in our pool, that means we have an upside of, how much is it? $10 billion just now, and it's going to get bigger in the future. So we're essentially going to be a perplex that has a potential liquidity of $10 billion. So it really solves the liquidity issue that a lot of the perplexes, DeFi, and every other finance has. So pretty optimistic about this, pretty happy about our structure, and yeah, thank you.
Wow, very interesting statements, and I think it's a great time for Brian to share
Yeah.
your thoughts as a
Yeah,
person
maybe
who's building
for
the blockchain.
for the sake of for the sake of the Twitter space, I think we could have some. I can disagree in a couple points now. So I think that saying Ethereum is like the only chain that needs to exist. It's like I kind of get it, like in today's context with the way things are today, but like in the history of the internet, if that approach was taken in like 1997 to say like Yahoo is the only search engine we ever need, like look at how much we would have missed out on by deterring continued innovation from new entrepreneurs who think they can do it better. We always want more competition, and we always want that competition because it increases quality. If there's no incentive to do something better, what you're going to get is just stagnation, and things won't improve. They'll just kind of stay the same and monopolize. So certainly disagree at that point. And I think we're already seeing other networks doing certain things better and other things worse. The cost to run apps on Solana is certainly a lot cheaper and better for the users, but it goes down and offline for 8 hours every now and then. So that's terrible, right? So there's no better solution per se yet. Most of the liquidity is on EVM. But like the day is coming where there is the next greatest thing and it's going to be better. So how long that is, no one can say. Writing off something like SocialFi, I have a personal bias for SocialFi because one of the dApps building on Partisia is called party.com, PARTI.com, and I contribute to this as well. And I see, you need to think of like, well, who are you solving the problem for? It's really about streamlining the business model for the creators, right? Like that's where the big breakthrough comes, is when the creators finally find a better venue. Distribution on Instagram, X, Facebook, the big platforms. It's almost like it's the biggest mountain ever to climb to try to like be able to build a platform that can reach the level of distribution that they have. So like the challenge is certainly astronomical, but again, like the upside for everyone involved is also astronomical. And at some point, the promise of the blockchain allows creators, especially, AI is really changing everything, because you can have content being created so much faster, hitting the web, being distributed. But if, systems are moving to the chain where you're tracking usage and you're able to monetize better and keep better control of your intellectual property, and the monetization starts coming on the chain rather than off chain, and it's from peer to peer, like the initial revolution was a peer-to-peer currency system, Bitcoin. So the blockchain has this promise of a peer-to-peer everything system where you just don't need the middlemen anymore, because the processes can be so well automated, so much fraud detection, spam detection, that can clean everything up, via automation rather than humans. And being able to have the creators connected directly to their users, it disrupts the Shopifys who they use the software to sell and lose 20%, whatever. It disrupts the, Twitches and OnlyFans who the creators lose 20 to 50%. So it's going to get down to a point where the creators finally have the tooling, because entrepreneurs are working to make it for them, where they can monetize this stuff and keep 99% of the haul, and they, people are following them across all their venues. They've built up these huge audiences and brands on Instagram, Twitter, whatever, but they're going to be able to then use Web3 software to drive all the traffic to themselves in a new venue. And that's like something we're working on with Party, is like you just link everything across your other venues whenever you're live or whatever, and you monetize in crypto, and you're getting 100%. So I think all these things, it's a time issue. Like it's not going to happen tomorrow. It's a 10-year time horizon from now to then, and AI is definitely speeding things up. But I'm all for, let's challenge Ethereum, let's make better chains, let's make SocialFi platforms, and not just give up and fold to the Instagrams and Facebooks of the world, and X's. Let's give the creators complete control of their data and monetization. Let's eliminate 20 to 30% fees and, robber barons running these tech companies, and then censoring the information and, working with the power systems to push their own agendas. Like that's what we're here to do as an industry. At least that's how it started. That revolution of the Bitcoin peer-to-peer system is dying by the day as the ETF absorbs more supply. But let's keep the eye and focus here. It's all about innovation and challenging the system. We don't want to settle for just ETH. We don't want to say no SocialFi. That's my take.
Thank you so much, Brian. Very motivational speech for every Web3 builder, investor, and innovator. And I think we discussed a lot of great fundamentals topics today. And I want to go a bit more deeper into the specific products that you're guys building. And let's start with AARK. So Eden, you guys at AARK aimed at incorporating the best of decentralized exchanges and centralized exchanges into one platform. what are those features to like making it the best tool, and how do you benefit your users of utilizing ARK instead of other solutions?
Okay. I think so just from a statistical perspective, only 2% of the volume for Perpdex is happening on chain. The big reason is because for high frequency trading, it's just not feasible on chain, like everyone knows. So there's no institutional volume and everyone's just retail. And we saw this early on when we started this business. So for example, like in centralized exchanges, you have only 10% of the people actually doing above 20x leverage. But if you see the perp dexes, you see 80% of the people doing above 20x leverage. So it's clear that the retail are more degen. The slow execution speed and everything is more tame towards the retail. So as to why we're providing the 1000x experience is because we understand who's on chain. Institutions will never touch something like this, but some classes of retail will definitely touch something like this. So, so what I want to say is, since the question was, how are we combining sexes and dexes? We're trying to give close to a centralized exchange experience, meaning that because 98% of the guys are off-chain, we're trying to make it so that it's really seamless and easy for them to come on-chain. And everything except one thing is possible, and this one thing is gas fees. So other than gas fees, like user interface, everyone talks about that. Everyone's like, oh, we have CEX class user interface. We have that too. That's pretty a norm now. 1CT, where you don't have to approve every contract. Transaction speed, Arbitrum is doing not such a bad job on that. And just the hurdle is the gas fees. So I think we touched on almost everything to make that seamless. And I think the last piece where the users don't feel the gas fee is for blockchains like Monad and Layer 3s to really solve.
Great, thank you so much, Inan, and definitely suggest everyone to play with the platform and to try this user experience, and excited about your new features. And yeah, giving a mic to Sabi.
Yeah, so very interesting conversation. Actually, I even forgot to react with emojis, to be honest. So I think let's go forward. Let's not interrupt the momentum here. And I have a question to Ritwik from SYNTHR. You focus on cross-chain transfers and bridges. How do you differentiate yourself from traditional bridges that many crypto users are currently using?
Oh, fair enough. So I think I mean, it's well established that I think we're way past the conversation where many chains are required or not, because I think it's clearly the current state of things, right? We have many chains, we're going to have more chains. And the idea was, how can we make it easy for users to be able to sort of go into each, because every chain is like an ecosystem in itself, right? It's like a nation within itself. It has its own culture. It has its own yield generating opportunities. It has its own artwork in the form of NFTs. So the idea was, how can we enable sort of, or this cross-chain movement has always been there. The idea is, how can we propagate it even more? How can we promote it even more? Because confinement will only sort of constrict innovation. And the idea is, how can we enable users to go from one chain to the other in the most seamless way possible? Because everyone who's probably been in DeFi or in crypto long enough understands the underlying challenges, right? And the idea was, how can we make the overall experience better? So that was the underlying sort of principle with which we sort of steered SYNTHR of using synthetic assets for more than what they can actually be used for. And and when we started looking at the space, obviously the idea was, how can we make bridging better, right? So the idea was, can we look at maybe eliminate the whole concept of, like, say, bridging asset to asset from one chain to the other, and build sort of a liquidity layer which users can use to go from one chain to the other. And the idea was, you use these omni-chain synthetic assets which are highly solvent, and you target the AMM-based bridges. Because when going from one ecosystem to the other, there are two ways in which users actually get screwed. Number one is, like I mentioned towards the beginning of this Spaces event, is that the cost at times is too high. I mean, users often don't know which sort of bridge to use, which bridge has high liquidity, and they end up getting screwed on the overall slippage. There are times when you're trying to enter new ecosystems and you end up paying northwards about 20% in slippage. I've seen users post and come and talk to me about where they spend nearly about 20-30% slippage, right? I've known of builders who are building and developers who are building in certain ecosystems. They face this problem as well. And so the idea was, how could we make it more and more capital efficient? And the idea is, if you can make it more and more capital efficient, then can we just probably have a liquidity layer which enables slippage-free transfer? So we said, okay, so we have to create a new asset in order to do that. Now, then came the whole thing about, okay, so if you're targeting AMM-based bridges and we want to eliminate slippage from the entire equation, so we build a synthetic asset liquidity layer. But how do we make it more secure, right? How do we ensure that these synthetic assets are always backed? Because once you create a liquidity layer, you need to ensure the solvency of that liquidity layer. So then we started working on, say, delinking the consensus layer from the liquidity layer, because we wanted to make it as secure as possible, deter collusion between, say, sort of core contracts of the liquidity layer with the underlying consensus layer. So we resorted on using independent consensus layers. So we thought that, you know what, we'll actually end up building this liquidity layer on top of the likes of an XLR and a layer 0. And we'll probably work with twin consensus. So if a user has to go from one chain to the other, he or she can actually validate that cross-chain transaction by paying a marginally higher gas fee. By getting that validated from an XLR plus a CCIP, or a CCIP plus a layer 0 for that matter, right? So once we ended up creating, say, some sort of a secure environment, then the idea was the whole capital efficiency aspect, using synthetic assets as the settlement asset. And in order to ensure the full-time backing of these underlying assets, we devised a cross-chain sort of debt sharing mechanism in which all the liquidity providers are effectively pooling in and supporting the debt, which is actually cross-chain, using cross-chain collateral. So one piece after the other is what led to creating this capital efficient and secure liquidity layer, which enables free flow movement of assets cross-chain. And once you enable,
faster, no?
Sorry?
And it's faster.
Yeah, it's instantaneous, absolutely. So
Yeah.
It's fast, it's secure, it's capital efficient. And once you enable this for users, then the gateway opens up for other builders as well, because we wanted to encourage. So we've given grants to two teams that are building. One of them is actually building an omni-chain perp ecosystem on top of SYNTHR. We've already given a grant to a team that's building a DEX aggregator. We recently found a team that is looking to create omni-chain prediction markets, and they're going to be using SYNTHR's liquidity layer to do that. So the idea is, once you create this capital efficient liquidity layer, the idea is not just users, but also applications can build sort of next gen sort of cross-chain solutions, which is actually going to be omni-chain, because cross-chain is still perceived as one chain speaking to another, but let the speaking be resorted down to the GMP layer. But if you can create a liquidity layer which is independent and is chain agnostic, it just sparks up the creation of a new generation of applications that can be created.
Yes, and I actually saw that on your website, which is actually it's a very good representation. So I really recommend to everybody to go and check it out. Thank you very much for this brief explanation, because I think it's great. So yeah, let's move forward, and I have a question to Brian. Since 2023, many new layer 1s and layer 2s have entered the market, including some specialized in DeFi and financial operations. What sets you apart, and which features do you offer DeFi builders and users?
It's a great question. So you're right. There's a lot of people coming into the mix, a lot of different approaches. We've done some things well that others haven't done well, and we've done some things not well that others are doing well. So to go through those, I think you need to really have a product that is actually solving a problem, because otherwise you become another Me Too layer 1. And I think it's Eden who said, we only need Ethereum. Well, that's true when you deploy another layer one that doesn't do anything differently. It's just like more centralized, so there's lower costs, there's less security. But, what we're doing is, we have a fully sharded protocol. So we have complete sharding. That means that, as most blockchains just form one block after another, we have 4 shards that can expand to, in theory, infinite shards, so that as more transactions are spiking on the network, you can open new shards. It's like opening new doors for blocks to finalize. So rather than one door to get through, like an ETH block finalizing or Bitcoin, you can start to finalize transactions simultaneously across different shards. So it's much more scalable. When you talk about things like high frequency DeFi markets where there's like a lot of transactions and it can handle increased users and finalization requests and transactions, you can actually scale. So that's an important component. The interoperability, we have a truly decentralized bridge. Without naming some of the competitors, they're completely centralized. They're running their own nodes in like Google Cloud servers. Now, they've done a great job on the business side of getting the initial user bases, getting a lot of volume. We haven't done as great of a job marketing or getting the attention because we've been focused more on building. Now, in the long run of 10 years, we think our architecture and security model is much better suited, more scalable, and ready to actually grow naturally and not suffer issues like hacks or things that centralization enable. So I think we've been building for the long run there. And, we use MPC technology, which there's a high barrier to entry to acquire. You need to go to like Fireblocks. We have our own key management software that's sort of open source and available for anyone. It's called Mocha. So anybody can, assign multiple counterparties and secure their assets on chain in a sort of self-managed on-chain open source custody product. So I think that's really disruptive to some of the enterprise companies like Fireblocks or Copper that are running these systems on an enterprise level. It's open and available for anyone, from just regular retail traders and users to enterprises. So, the next step for us is really getting the ecosystem to grow. We were off to a good start. There's probably between 20 and 50 dApps building, and they're starting to roll out one by one as we come to market. So I think our fundamentals are really strong, but we just need to really start to build awareness better, because the other chains, you can kind of call them hype chains. They're deploying Me Too layer ones, but they're actually getting tons of users and interest because they're making it a very fun ecosystem. So we need to become a bit more sexy, a bit more exciting to match the level of quality we're delivering. And I think we're in great shape to sort of stand out in the landscape of the different layer ones.
Well, I don't think you could have said it better, because I think innovation and marketing hand in hand is the most important at any company, blockchain or not blockchain. Is there anything else you wanted to add? Sorry, maybe I interrupted you.
No, I mean, the other thing is we definitely are looking to deliver real world use cases that are high impact. So like, for example, we have a private payment network running on our chain and the private smart contracts for the Red Cross, and they're delivering beneficiary aid in crisis zones with QR codes. So that's a big overhaul to the current cash system, where they literally come into crisis zones with bags of cash, and then there's no way to track the funds and make sure that it's being used properly. So that's a very high impact use case. Voting on chain, like being able to have more secure voting, transparent election systems. Again, long ways to full adoption in the world, maybe 10 years. But like blockchain voting, we're right there at the forefront. That's something that has such a huge impact. No one trusts the elections anymore. So
yeah,
we need to use the technology. So that's kind of just the final word is, then we have partnerships with different countries like the Georgian Innovation Agency, and we're helping them do some real world use cases. We are up and about to announce a country that's going to be endorsing our key management platform, so that all their tokenization projects that are regulated and sanctioned by this country are using the key management tool that they approve. So high impact, trying to be doing professional use cases, not just circus use cases. of pump and dumps and different NFT marketplaces. Those are fun and they're needed to keep an excited community, but in the meantime, we're also building high impact, trying to improve the world's systems with our tech.
Well, it seems that the industry is maturing, which is always great to see. Now we have one more questions to all our guests, and after that we will enter the Q&A. So if anybody has any questions, then you can ask to be a speaker and we will admit you. Alternatively, you can also write your question in the comment section and we are happy to take it and read it for our guests. So I'm going to give the words to Peter. Peter, you're on. Thank you. Thank you, Brian, for that.
And
Thanks.
as we're getting closer to the end of our spaces, in our great spaces today, I want to ask another general question to all our speakers. As we approach a new bull market, or we're already on the new bull market, as some people think, what do you think differs in the DeFi space during this upcoming or current bull run from the previous cycles, and or not only in DeFi space, but in crypto space in general? Curious to hear your thoughts. Eden, probably you can go first.
Okay. This is a very hard question. I think it's okay. I've been in the industry for 7 years, and when I first came into the industry, people called Ethereum a scam because there was not a single use case other than sending Ethereum to the other person. Now it's a different situation, right? Many things are happening, and institutionalization is coming, and I think that's just overall the biggest difference. There's more credit in the market, so people think it's more natural to get doxed. People think KYC and KYB as natural process. So we're seeing, like, as you mentioned, things like RWA coming up, and it's not just crypto guys using these technology and assets, right? So I think the Bitcoin ETF really speaks for our age. Bigger guys are coming in. Things are getting more structured. I think that's going to be the next phase of DeFi. So we're going to see less of things like Olympus DAO, ESD, yield farming, those kind of things, and more structured things. So yeah, I think that's the biggest change that's happening. Very positive about this. I wish there was some regulatory clarity on everything. I wish that people had to be censored to at least like provide financial services so that the general public doesn't think that this is a dangerous space, but somewhere that innovation can actually happen. So I think it's gonna be harder to earn money. Like before, you could just fork Uniswap and you could get investment for like $100 million valuation. A lot of more senses are coming in many other aspects. Valuation, people like I've been surprised to meet a lot of investors for the past few weeks, and compared to when I was raising a year ago, the new questions that I'm hearing is like, what is your revenue? So I was like, wow, people actually ask about revenue, and they were like, what's your burn rate? People used to not ask about those things, and it's actually really like the first thing people should ask you. So I think it's going the right way. There's a lot of volatility. There's a lot of things happening. There's a lot of confusion, but all in all, I think we're going in the right direction.
Thank you so much, Eden. Great answers. And from VC side, just to add as from our point, that process of due diligence, process of requirements, and to founders, and depth of research getting more and more mature in the industry, and it's harder to make money for sure, but we're all gonna make it definitely. And Ritwik, Brian, do you want to go next?
Yeah, no, I think like that's a pretty good assessment, but I don't think that there's only one. I think there's just going to be a divergence. There's going to be the more like regulated DeFi pools that start opening where you're whitelisting public keys that are allowed to trade in pools. So you know who everybody is, but there's at least that frictionless user experience where funds can flow without, middlemen, and everything's on smart contracts. That's a no-brainer. It's definitely coming and going to get more popular and more institutional use, which will lead to much higher on-chain volume. But then on the other side of the coin, there's going to just be the continuance of totally unregulated on-chain activity that, retail and other people, jump into and use. Like, I don't think there's going to be both. And I think there's sort of arguments why each one is better. And I think that on the unregulated side, you can get faster deployment, faster testing, faster user adoption, and see what's working, what's not. There's going to be tons of chaos and collapses, but booms, busts. But then, it's good because the innovation continues and you can kind of take the learnings and bring it over to the more, professional systems that continue to build on chain and leave behind some of the things that don't work. So I think it's good. There'll just be a divergence of more like the total Wild West versus the regulated side of things. And that same thing goes for financing. So you're going to have the more VC approach where VCs are trying to invest in crypto projects. Now, keep in mind in the ICO boom of 2017, the beauty of it was that, for anyone who was actually there and involved, it was a really magical moment because what you saw happening is VCs getting desperate because they couldn't get deal flow anymore because people went straight to the community. And there was like some talk at the time that VCs were going to be like disappearing because it was just democratized access to the early rounds of amazing new ventures and ideas. Now, obviously that ended in, I think 80% of ICOs just busting out and being complete scams versus the next 15% just failing, even though they weren't intended scams. And then, the 5% super successes. But I think that it's super important we maintain this democratized access to protocols, because if you look on the flip side, what's happened the last few years, and let's just say it and tell it how it is. Look at all the big layer ones that have all the hype. And then look at who the investors were in the pre-sales. It's the same 5 to 10, cartel VC groups who have all the tokens. They come and have a little bit unlocked at TG. Everything else is locked. And then they're in with the same market makers who open the price at, 10 billion FDV, even though there's almost no revenue occurring on the chain. And that's not fair. And then the retail people who in 2017 were able to get in on the first rounds and have real access, they're left to buy off, the few exchanges left on the CFI side of things. So, there's pros and cons when you start making things more gated and, not having this democratized access. What you get is cartel and the same groups, monetizing one project after another at overhyped valuations because of the way they control the tokenomics and the go-to-markets. So it's super important that everybody understands that and still in this industry wants to have this democratized access. You can still have KYC, AML. It doesn't mean you're throwing it away. It doesn't mean you're doing, open mints or token launches on, no KYC smart contracts that we saw back in the day where you do, a few $100 million on an ICO. It doesn't mean that we're going to get that because the users have learned and they've learned the hard mistakes. And they're educated through experience. So that's the main reason things have changed, because they've learned. So, there's room for everything. All systems are improving on the unregulated and regulated side, but I think it's just important that we don't close this off and make it another Wall Street, because that's not what this is for.
Thank you so much, Brian, for the extensive answer and very interesting topic of democratization of or gating the access to investments and access to launching the new projects and tokens in the space. And there's definitely a lot of room for improvement on the both sides. And as we're almost finished 1 hour, we want to give a 1 minute of alpha for all our guests. So feel free to take the mic and to share any important news, announcements, alpha, or exciting things that are going forward with your projects. And I'm sure our audience is eager to hear some exciting news from you.
Yeah, so I can probably take this. So we have an incentivized testnet going on at the moment. We're already at about 20,000 users. We're at about 3 million transactions, and we'd encourage more and more people to come in and try out what we're building. Omnichain products are still at a very, very nascent stage. We're still probably waking up from a cross-chain hangover, and we'd love for people to come in and just see what we've built. Enjoy what we've built, and yeah, we're just we're growing every day. We're now at a cusp where we're processing about 50,000 transactions daily and seeing a massive influx of users, and we just want more and more people to come and try out what we're building. So yeah, come and see out our incentivized testnet.
Amazing. Thank you, Ritwik. And the incentivized testnets are always very exciting for the audience. Eden, Brian, do you have anything to share from your side?
No, I think we pretty much covered everything today, kind of gave the value prop of all of our products here. So appreciate everybody for listening, taking the time. At Partisia MPC is our Twitter. Give us a follow. The link tree's there. You can join the Discord if you're on the developer node operator side, or the Telegram if you just like to chat, and can get involved in our community.
Is the mic working? Hello?
Yes.
Oh, okay. We have many bullish news. We have TGE next month. So listing is coming. We're announcing our new round of investors who are excellent, and you're all going to be surprised. We have a launch pad coming. We're going to deploy on Blast after winning the Big Bang. We have some amazing partnerships coming. So, we also announced the airdrop program today. We're the first project to airdrop to PIT stakers. So if there's any PIT stakers here, Jupiter holders or TIA stakers, you could all be eligible. So come and check us out. We have about 360,000 impressions so far. So we're gaining a lot of interest. So please join on the hype. Thank you for being here, guys.
Thank you, guys.
Thanks, everyone.
Peter, I don't think we have any more questions, if I'm right. I would like to thank everyone for being here. We are a bit over time, so yes, we don't have any more questions. Make sure that you join in for the other Twitter spaces as well. I myself usually conduct one-on-one interviews every 2 weeks, and in the next roundtable with other set of guests, Naini and Peter will be here again. Brian, Ritwik, Eden, thank you very much for being here, and thank you for the info you shared with me. Everyone, make sure that you follow all the projects and everybody in this space, because I think many more things are coming as the bull run continues, and yeah, to the moon.
All right, good luck, everyone. Make it happen this year.
Thank you,
Thank you so much,
everyone.
guys.
Right on.
Bye, guys. See you, guys.